All right, guys, T Rowe Price is a company, in full disclosure, that I own. Again, like everything, you don't buy anything because anybody else owns it, especially me. This is not investment advice. What I'm trying to do is I'm trying to teach a process. When you learn that process, you can apply it to your own investments and pick your own individual stocks and other investments to buy. That is very, very important. So T Rowe Price is a company that I currently own, $110 a share. Now look at this. This is the interesting part about T Rowe Price. All-time high of 224 back in August of 2021. So we're almost at 2 years now, and the stock is down 50%, right? Yep. And T Rowe Price is a very, very big leader in 401ks and a lot of assets under management, right? So in this video is great for beginners all the way to experienced investors. We have something for everybody along the way. We're going to go over the 8 pillars. We're going to go over analyst estimates, which we have on our site. We're going to go over the bull and bear cases and some recent news for T Rowe Price. And then we're going to cap it off with a stock analyzer tool. So, Mo, look at this. $24.78 billion market cap. Guess what the enterprise value is without looking, which you probably already did look.
I already looked, but it's almost exact.
So guys, the market cap is when you buy all the shares outstanding. Okay? Buy every share outstanding at the current market price. Enterprise value includes all the debt and cash, mixing it all together. This shows me there's like literally no debt in the company. So guys, this is great for a company. It's hard for a business to go under, just like you. Apply it to your own personal life. If you had no debt, essentially, and all your cash could pay off all your debt, wouldn't it be pretty hard to go bankrupt, Mo?
Yes.
Very, very difficult.
Yeah, you're in a good situation.
Yeah. And the fear of debt is always, can you pay it back? They can write their check, basically, and pay off all the debt in the company.
Yep.
That's awesome. All right. A couple other metrics. 1 year PE of 17.5, 5 year of 11.3. My guess is their fees have dropped a lot due to the market being down last year, right? Now the market's coming back up a lot again. Maybe that's the reason. I don't know. But look at this gross margin, 52%.
It's huge.
Yeah. That means for every extra dollar they bring in today, assuming they add no overhead, 51.8% is going to go to their bottom line before taxes. Yep. And after taxes, look at their 5 year profit margin, 34.7, last year, 22.9. So let's go take a look at that, Mo. Let's pull up their income statement, because obviously there was a big drop last year. Oh yeah, look at that revenue drop. Guys, this is assets under management. So I want you to remember this. When the markets fall, their revenue is going to be hit very, very hard. You look at this and look at the amount of growth in the last 10 years as the market went up and up and up. It just kept going up. Look at 20 years ago. They had $1 billion in revenue. So they're 6 times larger than they were 20 years ago.
Yeah, I went back to 2008, 2009. They did see a downfall in revenue.
But not as much.
But not as much, right.
You know why? This was literally the bottom. March 9th of 2009 was the bottom, and the year ended up in the positive. So immediately rebounded, goes back up again. Now, what kind of bear market are we going to have? You believe we're going to be in a bear market? Is it going to be long? Even if this company stays flat, the great news is they have a lot of 401k people. That's what I like.
And it's hard to leave 401ks.
Well, you as an individual, you can't. Your company has to leave. And every week, every pay period, more money is being added. Yep. So I think for T Rowe Price, what's really, really important is to look as long as you can in terms of your time horizon, right? You have to be, so I think a minimum of 10 years looking at this company. And I think there's going to be a lot of volatility in this company as well.
Yeah,
because
definitely.
if markets fall 40%, what's going to happen to this revenue?
Yeah, it's going to plummet.
It's going to plummet, right? So that's something to consider there. All right, let's go to the 8 pillars here. Oh, okay, that makes sense. 5 year PE of 11.3, 5 year price to free cash flow of 12.7. Everything else is a check mark. I like this now.
I like their ROIC too.
Oh yeah, great ROIC.
Yeah, I love their shares outstanding, decreasing.
Guys, they're getting a good return on the money invested in the business. Now look at this though, Mo. 1 year ROIC, a lot lower.
I know.
Because their net operating profit was probably a lot lower because of a fall in revenue.
Right.
My guess is they didn't eliminate a lot of their overhead because of it. Now, guys, remember, if you have our software, you can modify your pillars and it'll show up above. You can have up to 12 pillars instead of 8 and 4 quadrillion plus different variations of it. And actually, it's probably even more than that. I just stopped counting it at 12 zeros or whatever the number of zeros is.
Did you start like 1, 2, 3, 4?
I was like 1, 2, and then Mo interrupted me, so I had to go back to no. 1, 2. All right. Dividend yield, huge dividend yield.
Yeah, it's big.
Now, guys, the question is the dividend safe? Paying out $1.1 billion in dividends And last year's free cash flow is 1.5, and the 5-year average is 1.96. I prefer a dividend to be under half of the 5-year average free cash flow. And this is getting up there. So if revenue falls another 20, 30%, something tells me this might be in danger.
So the 5-year average is 1.96, but in 2022, the free cash flow was 3.3 billion. So that really pulled it up.
Yeah.
Every other year was 1.5, 1.53, 1.9, 1.52.
Guys, I'm going to tell you right now, I think this is in danger if revenue falls more.
Yeah, they'll cut that very quickly.
Yeah, I do believe that. I do agree with that. Oh, look at this enterprise value to earn. I mean, these are very low numbers. But guys, again, this is a long-term play potentially. So Mo, can you go before we go to analyst estimates, can you go over some bull and bear cases for this company?
Yeah, so bull cases. In 2021, they partnered with FIS. It's I think they do payment systems.
Okay.
My friend works for them.
Oh, really?
To manage their retirement technology. The industry's largest record keeper, whose platform includes 50 million participants and $3 trillion in assets. So that's just one way for them to really bring it all in even further. 60% of American adults don't have a retirement-specific account, so they have a long runway.
Yeah, and that's the thing. If you look at history, the participation rate in retirement, especially as pensions have gone to the wayside. Yeah. I mean, pensions 40, 50 years ago were a huge thing, way less now. So as time goes on, people will be putting more money, hopefully, into 401k.
Yeah. Now, bear cases, and this is one that we talked about, they pay out 60% of their 5-year average free cash flow in dividends.
Yeah, I listen, guys.
I just think it's going to get cut.
Yeah, I think it's going to get cut as well.
And I don't think that's a bad thing.
Well, that's
people are going to perceive it as bad. Of course. But yeah. It's a highly competitive industry.
When I'm on Twitter and I see the number of dividend people just focused on dividend, and you know, somebody the other day said, look at this company and their dividend yield. Are you buying it? I wrote, don't just buy a company because of dividend yield. And he wrote back, I'm not. I was like, well, all you mentioned was the dividend yield.
Yeah, yeah.
Dividends are a very attractive thing, guys, but remember, it's not free money. It comes out of the company.
Right.
It comes out of the company. So it's less on the balance sheet.
Right.
Now, is it nice to get that check every month? Absolutely. I love dividends just like everybody else. Yeah. But if they can do a better job of cutting the dividend to buy back, let's say hypothetically T Rowe fell in half today. Buy the F out of those shares.
Yep. And it's nice that they have been.
Yeah, but buy the F out of those shares. Yeah.
Don't pay a dividend. Cut your dividend to zero.
Yeah. People, you know, that's a very unpopular statement to make, but Mo is right. If the stock fell to $50, I'd be like, cut that dividend to zero and just start buying back shares like crazy. It's way more tax efficient for you as an investor.
Yeah, and you'll be happy in a few years.
Here's the example before I lose some of the beginners here. And even some of the advanced people, if there are 10 shares outstanding and you own one, you own 10% of the business. If they buy back 7 shares, now there are 3 shares outstanding, you own one, you own a third of the business. That's the big key. And I was going to an extreme about buying, but look at some of the best stocks ever. Now, NVR, AutoZone, they just bought back 70% of their shares.
Yep.
And that's where, because now you're splitting the profit up amongst 3 shares instead of 10.
That's how you create huge multi-baggers.
Yeah.
It's not from the stock price going up and you just keep holding. It's them buying back their shares.
That's a big driver of multi-baggers.
Plus the shares going up.
But. All right, go to some another bear case.
So another bear case, and we kind of already talked about this one too. But I also can see this in the bull category. Highly competitive industry. They only have 1% of the market share.
1.7?
1.7% of the market share. So I look at that as a positive also.
Especially with their name.
Yeah. It's funny when you start going, if you want a little exercise, go and see who the main holders are of many big companies out there. Apple, Microsoft, NVIDIA, all these companies. It'll show you of JP Morgan, BlackRock, those who invest. T Rowe Price is always on there. So
there's a lot of T Rowe Price out there.
It is not, it's not as big of a name, but they sneak their way in there.
As JP Morgan,
exactly.
Right. Okay. So let's go to analyst estimates here, which I'd be interested to see what see, they're expecting still driving up, maybe because analysts don't expect markets to fall. But $6.91 this year, they're expected to make per share. $8.44 in 2027. Not big jumps, guys. Not big jumps. You got to remember that. And let's go down to revenue from the analysts. Very few analysts following them, by the way. 14 for this year. I mean, again, not big jumps.
Nope.
Guys, so this is a company that you got to focus on buying back cheap shares, hoping the stock falls so they can buy the cheap shares. And if they don't, and they keep that dividend going, great. But this is hopefully a play long-term to say, I can buy it cheap enough. So how do we know we're buying it cheap enough? Well, insert stock analyzer tool. So this is why this tool is so important. You can make your assessments about the future. You can make your assumptions about the future, and it'll tell you what price to pay today. This was used 1.3 million times last year alone by our users. And this is part of a bunch of tools we have here. Retirement calculator, analyst estimates, 8-pillar search, 8-pillar portfolio, real estate calculator coming very shortly. And for those of you who sign up now, you get the real estate calculator grandfathered in because it's going to be its own separate category soon. And you get this community here. Thousands of like-minded investors where you can go in there and have a conversation specifically about T Rowe, what people have seen, what people like and don't like. Because research is so much easier as a group than it is individually. Go to everythingmoney.com, $7, 7 days, $1 per day, no brainer. It'll change the way in which you look at money. So, Mo, let's do this. Revenue growth. Give me some revenue growth numbers, low, middle, and high.
So I was going to go 2, 4, and 6. 2, because let's say that it doesn't work out. Markets are down for the next decade and things are just suck.
Okay. 2, 4, and 6.
6 is what they've done for the last decade.
Okay. But it's been a good decade.
It has been a good decade.
I was actually going to say 0, 2, 4.
Ooh, okay.
Really?
Or
you okay with that?
0, 3, 6.
0, 3, 6. Thank you. Good call. All right, profit margin. Now, profit margin's down right now, but it's been a lot higher. And I think this is the kind of company that would cut expenses very quickly if they had to.
24, 28, 32.
I love it.
Okay.
Free cash flow margin?
I was thinking go maybe higher. I think it has to be lower, don't you think? Because of history?
Oh, yeah, you're right. Maybe so.
22, 24, 28? I think 28 is too high.
What about 22, 26, 30?
Okay.
Because they did 30 in the last 5 years, so they keep continuing to do it. Okay. Now, PE, guys, remember, the PE and price of free cash flow currently should not matter to you.
No.
What we look at is, okay, the market average is 15 to 16. Start there. If the ROIC is high and the growth rate is high, you go higher. If they're low, you go lower. So this ROIC is somewhat declining, though. So the question is, with an asset manager, I think this is going to be a very volatile stock, Mo.
Yes, it will.
So what do you think for PE here?
I was thinking 15, 17, and 19.
Okay. Desired annual return, guys, you can get 9 or 10% by investing in ETF. So the question becomes, what kind of return do you need? As your assumptions go higher, you need a higher margin of safety. All right? You need a higher margin of safety.
9, 11, 13.
Really?
Well, I was looking, 0% revenue growth would shock me. So that's why I was like, I can go lower than 10. 6%, that's a lot. I don't know, what were you going to put? I
was going to put 10, 12, 14, only because there really is a lot of uncertainty where the market's going to be. But yes, you said 0% is really low. Let's stick with 9, 11, and 13.
Never forget.
Now guys, you got to remember, what's going to pop up is going to be 6 numbers. Actually, 9 numbers. The first 3 are a value based on earnings. The next 3 are the value based on free cash flow. And the final row will be if you paid the stock price today and the low numbers hit, what's your return going to be? Middle number hit, what's your return going to be? High numbers hit, what's your return going to be? We added this to the stock analyzer tool to tell you, listen, paying today's price it'll get you this return. If you're okay with that, go for it.
Yeah.
So stay with me through the end of this video because we do add some commentary after this. I want to make sure you hear our comments about these numbers and our reaction. Boom. Low price, 75 to 80. High price, 136 to 145. Middle price of 100 to 110. I have it at 100 on my watch list. Now, guys, that's the big key. If any of these prices make sense, add it to your watch list, and it'll notify you on the app, on email, and on here. Since the market's been up so much, I've gotten 0 notifications from any stock. But here's the key. If you pay today's price of 109.55 and the low assumptions hit, you'll make 3.5%. The middle assumptions hit, you'll make about 10%. High assumptions hit, you'll make 16%. Now, remember, guys, I think this is going to be a volatile stock. You've got to be ready for volatility in any stock in the market right now based on where valuations are.
Yep. If the market comes down, this is absolutely coming down.
And it's going to get crushed.
Yep.
So, guys, everythingmoney.com, $7 for 7 days, gets you the software. It's a no-brainer. Check it out. Thank you very much for your time.